Let's get more on this now with Mark Humphrey-Jenner in Sydney. He's an Associate Professor of Finance at the University of New South Wales Business School. It's good to see you again, Mark. Now, let's talk about the fallout of these tensions, first of all. They're being felt quite strongly in the US, aren't they, with the dollar, stocks and treasury yields down?
Well, firstly, thanks for having me. And I guess the tensions have been definitely very well felt and very noticeable in that they did cause the stock market to pare back some of its gains earlier this year. And in particular, there's some concerns about what might happen with tariffs and whether the current tariff rates on the UK of 10% and the EU of 15% might ultimately increase. Exactly where they'd end up settling, well, it's not totally clear, but the tensions surrounding that would generally be harmful for companies, whether they're importing goods directly for sale or importing things to manufacture in the United States, and then ultimately not particularly beneficial to consumers. So that could explain part of why the stock market has been paring things back and why we've seen gold prices increase and also what we've seen happening with yields. That in addition to concerns about Federal Reserve independence and geopolitical tensions elsewhere. For example, the United States' actions in Venezuela, all of this compounding since the beginning of the year.
Right, now, European investors hold around $8 trillion in US equities and bonds. Doesn't that make the US more exposed if sentiment turns?
Certainly. So, say sentiment turns between Europe and the United States. There's a few ways the significant European holdings could play out. Firstly, if people become nationalistic, in theory, you might see a sell down of US assets. I imagine that's going to be at the margins, in large part because many of the investors in Europe are going to be institutionally facing. So, for example, they're going to be managing money for clients, or the clients are going to want to maximize their returns, meaning they're going to still want to be invested in the United States. And the trade war that could ensue, that could harm both parties ultimately. So if they are choosing between the US and Europe, then ultimately they could end up with choosing which of these is the least harmed by a potential trade escalation between the two. Another way it could play out is if, for example, European governments start to intervene, particularly for nationalistic reasons, then you could ultimately see a bit of a sell down as well. And then finally, as dovetailing into the first point here, if this does harm the United States and Europe, you could see a reallocation out of the EU and the US into Asian markets, which could ultimately result in a bit of a sell down. However, I suspect that the mere fact of there being tensions would not cause the sell down per se. Rather, it's going to be the escalating or ramifications of that, because managers ultimately are managing clients' assets in order to try to maximize gains for them.
All right, we'll leave it there for now. Mark Humphrey-Jenner from the University of New South Wales Business School. Thank you very much as always.
Thanks for having me. Great being with you.